So you've decided to get into investing. You open up your laptop and boom, you're immediately thrown into this whirlwind of information. But what if I told you that behind all the charts and the flashy headlines, there are these huge, almost invisible forces at play? Well, in this explainer, we're going to pull back that curtain and look at what really drives the market for everyday people like you and me. Okay, so picture this. You're browsing online and you come across an analysis that looks just like this. It's packed with all this jargon, right? Weave 4, Fibonacci extensions, Ichimoku clouds. It sounds super smart, and the conclusion seems so certain. The price is definitely going up. And you start to feel it, that little surge of confidence. But then you click on another link, and you see this. A completely different analysis, but just as confident, just as sure of itself, and it's predicting the exact opposite, a total crash. And just like that, all that confidence, poof, it's gone. Now you're just confused. I mean, who are you supposed to believe? For millions of us, this is what it's like every single day. You're in an arena and it's just flooded with all this contradictory noise. You've got experts yelling from all sides and they all claim to have the one true answer, even when their answers cancel each other out. It's totally overwhelming, and you know what? It kind of feels like it's designed to make you act fast, maybe before you've had a chance to think. And this brings us to the real heart of the matter. Is the key to all this really about becoming some kind of genius who can figure out these crazy conflicting signals? Or is the most important battle being fought somewhere else entirely? Maybe inside our own heads. Let's dig in. So it turns out all of us, we're basically pre-wired with these powerful psychological biases. They're like mental shortcuts that our brains use. And look, they're super useful in our day-to-day lives, but they can be an absolute disaster when we're trying to make financial decisions. And one of the biggest, most powerful ones is something called the disposition effect. To put it simply, we're really quick to sell our winners, but we hate to sell our losers. Just imagine a gardener who's out there watering their weeds every single day. But every time a beautiful flower starts to bloom, they pull it right out of the ground. It makes no sense, but it feels right, doesn't it? It feels good to lock in a small win. And it's really painful to admit you made a mistake by selling something for a loss. And this isn't just some vague idea. The data is crystal clear. Check out this chart from some economists at MIT. It shows how likely an investor is to sell a stock in any given month. See that black line? That's for stocks that are making money. It's consistently higher than the gray line, which is for stocks that are losing money. In plain English, we are, without a doubt, way faster to sell our winning stocks than our losing ones. But hold on, because this is where it gets even trickier. It's not just our psychology that's pushing us around. There's also this powerful financial reason to do the opposite, and it's called the lock-in effect. See, to avoid paying capital gains taxes, it's often smarter to hold on to your winning stocks. So you've got this tug of war going on. Your brain is screaming, sell the winner, but the tax code is whispering, no, hold on to it. And this is where the research gets really cool. Scientists compared how people trade in their regular, taxable accounts versus how they trade in tax-free accounts, like an IRA. The results were astounding. When taxes are on the line, people actually manage to fight their own instincts. They become less likely to sell their winners because they don't want that tax bill, and they become more likely to sell their losers, maybe to get a tax deduction. It's the smoking gun, really, proof that these outside forces can literally rewire our financial behavior. So we've established that we're all fighting this battle inside our own minds. But you know what? That's only half the story. The other battle is against an opponent that most of us never, ever see. We're talking about the machines. Just take a look at that number, 50 to 60%. That's how much of all U.S. stock trading is estimated to come from high-frequency trading firms. The modern stock market isn't a bunch of people in jackets shouting at each other on a floor anymore. Nope. It's a massive network of supercomputers executing millions of trades in the blink of an eye. And you've got to understand, these machines are not neutral players. Their entire business model is built on volatility. They are programmed, literally, to make money from the exact same kind of wild price swings that cause us humans to freak out and sell at the absolute worst possible time. The crucial point here is that the very nature of the game has changed. Studies show this kind of trading can crank up short-term volatility by a huge amount. It can cause flash crashes. You might remember the one in 2010 that vaporized $1 trillion of market value in just a few minutes. It basically pours gasoline on both buying and selling frenzies. And at the end of the day, it creates a massive speed disadvantage. By the time you or I can even react to the news, the machines have already made their move. So when you're faced with your own internal biases on one side and these super fast algorithms on the other, It's easy to feel like the whole game is rigged. But here's the thing. Just being aware of these forces, just knowing they exist, is the first and honestly the most important step you can take. Listen, the point of all this isn't to give you some secret magic formula for picking stocks. It's to give you a completely new way to see what's happening. It's like putting on a new pair of glasses. When you understand the psychological traps and the algorithmic opponents, it changes everything about how you see the market and your own place in it. Okay, so let's tie this all together. What have we learned? First, the market is constantly screaming contradictory advice at you. Second, your own brain has these little glitches that can lead you to sell your best investments and hold on to your worst. And third, you're not just playing against other people, you're playing against machines that are faster than you and built to profit from chaos. Just knowing this, truly letting these dynamics sink in, is your single greatest advantage. Which leaves us with one last big question to think about. The next time you get ready to make a move, ask yourself, are you making a decision that's based on your own plan, your own goals for the future? Or are you just reacting? Are you just playing the short-term game that your own psychology and the market's algorithms are practically begging you to play?